Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick, Caroline Hyde, Taylor Riggs counting you down to the closing bell. And here to help take us beyond the bell, it's our simulcast with Massar and Tim Stenovec. We welcome our audiences across Bloomberg Television, Bloomberg Radio, as well as on YouTube. Another day here, guys, where we focus on the macro, we focus on financial market stability, and I guess to a certain extent, we focus on the fundamentals. And right now, none of them seem to be looking pretty good.
No, exactly. Certainly feels that way. And talk about bouncing around. We saw some momentum, certainly, to the downside as a result of the news out of the governor of the Bank of England. But it's just a reminder that stuff comes at us, comes at investors from any perspective and any part of the world. And it's just another reminder that we are certainly global markets and all connected.
We just had a great... Go ahead.
No, I'm sorry, Tim. I didn't mean to step on you.
That's okay.
You can't interrupt people on the show, Taylor.
No, very unpaid. Very unpaid.
Excuse me, who just said that?
Hot kettle.
Hot call, yeah, exactly.
All right. We just spoke to Doug Ramsey. He was actually in our studio for the first time in, close to 3 years. It was really great to have him join us. And he made some really interesting comments. He said that he assumes the Fed has already overdone it, and that inflation has already peaked, and we'll see it come down significantly. He talked a lot about the negative wealth effect, the idea that people feel less wealthy, so they're going to spend less, and which will, of course, decrease consumption.
I think that's right. I think when you think about sort of big picture, these central banks that are finally trying to test the market and say for the first time really in a decade, Caroline, we're trying to figure out what things are worth. Money isn't free. Nothing is at 0%. There's downside for the first time in a long time. And that's a conundrum that these markets, I think, are trying to get through.
What was it, tiara, that Ed Campbell just said? Finally, there is some sort of an
reasonable,
catch a falling knife.
And we talk about here kind of the big volatility that we've seen in this market. The Dow Jones Industrial Average that had been the bright spot on the day. It was up as much as 1.4%. Was going to close today only higher by about 0.1% here on the day. I want to point out, though, the S&P 500 here. We're down about 0.7% to close out the session. Closing in at 3,588. Now, remember, we closed below that 3,600 level back towards the end of September. But I thought it was interesting this morning. This was actually the first day that we actually opened below 3,600 going back to November of 2020. So you talk about the round trip that effectively has been put in place for the S&P 500, as well as the NASDAQ composite, which is down another percent here on the day, back down to that 10,426 level. You are seeing some activity in some of those cyclical names. The Russell 2000 going to finish the day higher in the green, but only by about 0.1% here on the day. It was much higher earlier, but a lot of those macro concerns really kind of scaring people off.
Yeah, I feel like all over the place in terms of the market moves today. Right now, though, as we settle in, and we're going to talk about major industry groups, the S&P 500, more risk off, 303 names to the downside today, Taylor, 198 lower, 2 unchanged. So definitely, again, a more of a negative tone today.
Yeah, Carol, you see that on a sector level as well. Take a look at where we're on some of the individual sectors here. There's some red, even in the, quote, best performers. For a radio audience, we'll make sure to tweet this out to you. Let's start with the winners. There were some. It was defensive in nature. It was sort of an inflationary hedge in nature. It's food and staples, it's durables, it's real estate, it's food and beverage. Those are sort of the sector winners. Unfortunately, Carol, as you mentioned, there was a lot of red, and the red gets worse, off about 2 to 3%. It's all those long duration assets with yields rising, technology, software, media, semiconductors, auto components. And the banks are down there as well, off about 2.6% ahead of some of those earnings that we're going to get on Friday.
All right, here's to some of the individual gainers, and we've talked about this throughout the day. American Airlines up at almost 6.7% at its highs today, still finishing a gain of about 1.7%, rallying after lifting its third quarter sales above prior guidance. So it's talking about revenue in the period expected to be up about 13% over the same quarter in 2019, slightly better than their prior outlook of no more than a 12% increase. So that was up. Top in the S&P 500 and NASDAQ 100, Micron Technology, despite pressure on the overall semi space, Micron was up about 4.5%. We did see quite a wipeout yesterday following that Friday news of curbs on China's access to semi-technology. So you've got that going on. And then Amgen was up almost 6% today here at the close, top in the S&P and NASDAQ 100. It's a result of a Morgan Stanley upgrade to overweight from equal weight, highlighting the unappreciated upside in the biopharma's midterm pipeline, and the price target raised to $279 from $257. Stock closing at $245 and change today, Tim.
All right, you got the gainers, I got the decliners. Let's start with Microsoft. I picked this one yesterday as well. In the last 4 days, it's actually shed nearly $180 billion in market cap, finishing the day down by 1.7% today. It was the biggest loser in terms of weight on the S&P 500 and on the NASDAQ 100 today. The information technology sector, I should note, down 33% so far this year. It underperforms the nearly 25% decline that we're seeing in the S&P 500. Tesla also weighing on the NASDAQ and the S&P 500, down 2.9% today. It's down for a fifth consecutive day, shed about $100 billion of market cap in that time. There was also this news out. It didn't necessarily move the company's stock that Elon Musk denied a report that said he spoke directly with Vladimir Putin about Ukraine. He did say he last spoke with Putin 18 months ago, and it was not about any sort of war. And then Lyft finishing the day down. Go ahead, Romaine.
That's swell.
Yeah,
Right,
it was. I was
nobody
surprised to
interrupted.
see this. I mean, this is.
Was this during the war?
No,
How long ago was that? That was
18
prior
months
to
ago.
the war? Okay. All right.
Yeah,
Just checking.
The current war. That's
Yeah.
the thing to keep in mind. I mean, we know that Russia has annexed other parts of Ukraine and other parts of Ukraine in the past.
Okay. Well, it's good they're in communication.
Yeah. Lyft down 12% today, among other gig economy companies. Uber finishing the day down about 10%. DoorDash also falling. The Biden administration issuing a proposal for a federal rule that would change the way it approaches workers' employment status. That could really change the way that these companies do business. I was a little surprised that the stocks moved this much on this because we've been talking about this for so long. We saw what happened in California. We saw what happened in the UK. But obviously it caught some investors off
Did you
guard.
hear the comments from Uber itself, kind of saying this is no big deal? This just kind of takes us back to the Obama administration rules. So
Yeah.
even they're saying it's not that big of a deal, but whatever.
We'll see.
Yeah.
Well, it's old again is new again. And let's go back to some of the geopolitical risks that have the market upended at the moment. We had, of course, a bit of a rally in the interim of today. At lunchtime, we got galvanized into thinking that the dollar should perhaps go lower. And in fact, we piled back into some of the more risky assets. But then it all dialed back again, largely in part because of Andrew Bailey, the governor of the Bank of England, coming out and saying, look, you have but 3 days, pension funds, to get your house in order before we stop supporting the bond market. Well, it meant that the British pound sunk by 0.75%. It is weaker versus the US dollar, moved back into the haven that is Bloomberg Dollar Index, that gained some 0.2%. We see across the board the sell-off that goes into the commodity space. That has actually been resolute all day. We are worried more about geopolitical risks, perhaps worried about Ukraine and Russia, and indeed that has an impact on the wheat market today. But oil is on the downside as we worry more about those global recession threats, the talk coming from the IMF. WTI off by 1.9% overall. Brent crude was down 2.7%. And in fact, you see metals that we've been selling off as well. And I look at a sovereign bond market that, if the UK had been open, we'd see a big move, I'm sure, in gilts, as we heard from Andrew Bailey after that market had shut. But indeed, we did start to see overall in the day's trade a movement out of certain of the markets. Japanese yields had been pushing higher, so too had Norwegian on the back probably of the oil move, Taylor.
We're seeing a huge sort of inflationary narrative, Caroline, when you think about full faith and credit. Again, another relentless climb higher. It's not the big sort of double-digit moves that we've seen, but you're still getting 6 to 7 basis points across the curve. Carol, we'll take out yesterday, of course, because the bond markets were closed. Outside of that, again, 4 straight days of this move higher. I wonder about the correlation with the NASDAQ that's now been lower for 5 straight days and the impact rising yields again are having on the equity markets.
All right, so now our shift, I guess, is to some of the economic data points coming up. We got PPI tomorrow. We've got the FOMC meeting minutes, and it'll be interesting as we kind of go through those minutes how we put that against what we've heard from Fed commentary. And I'm thinking about some of the back and forth. You've got Cleveland Fed's Loretta Mester, talking about, a lot more hawkish. You also have, different people saying they're concerned about stress in the financial markets. Others saying, expect some volatility. That's what's going to happen. It's kind of this back and forth, if you will.
Yeah, but I mean, we don't think anything is actually going to change before the next Fed meeting. This is kind of the last most important data point for the Fed. I'm talking about Thursday's CPI report, or the last CPI report that we have before the Fed's meeting on November 2nd. And, everybody's just saying 75 basis points. That's what traders are betting on, and that's seemingly what the Fed speakers are saying.
Well, yeah, and I mean, there's really nothing, I guess, to knock them off that pivot. I mean, you talk about the PPI numbers tomorrow, the idea that, we're going to be, above 8% on the headline, but even on a core basis, above 7%. That's basically what's in the pipeline, presumably coming to consumers, unless, of course, some of these companies want to eat the costs. But how many companies have we already heard basically saying, look, we're raising prices, and at least for now, consumers seem to be taking them. So what does that mean then for the CPI number? It's, as Taylor would say, it's second order, first order, what is it, fifth order effects?
It's the first derivative, second effect.
First derivative. Okay. All right.
And also, well, what does the 17%?
Do you divide that by 6 or 7?
What does
Love
that
you,
mean?
Romaine.
All right. Well, we've got a lot to talk to, and we'll continue tomorrow.